Payday loans are short-term, high-cost loans designed to provide quick cash. Let's look at how they function and why they are controversial. At their core, these are unsecured loans meant to be paid back by your next paycheck, often carrying very significant risks. Because these loans are short-term, the interest rates are often expressed as an annual percentage rate, or APR, which highlights their high cost. The process is designed for speed, requiring only proof of income and a bank account rather than a traditional credit check. While credit cards require a history check, they offer much lower interest rates and more flexibility compared to the rigid structure of a payday loan. Comparing the fees for a small, short-term loan shows how quickly costs can add up when using high-interest payday services. Because the high fees can make it difficult to pay off the principal, many borrowers find themselves repeatedly taking out new loans. Always explore lower-cost alternatives like personal loans or credit union assistance before choosing high-cost debt. Thanks for watching.